Welcome again to one of our video recording discussion in strategic cost management. And today we will be discussing capital investment decision, which is chapter 13 in your reference. The following are the expected learning outcomes. At the end of the discussion, the students are expected to be able to define capital budgeting, state the characteristics of a capital investment decision, describe the categories in capital investment, state, explain, and compute the elements of capital budgeting, which are in net initial investment, the annual net cash returns or savings, and the minimum rate of return. Discuss the process of capital budgeting, enumerate and explain the categories of project cash flow, apply the techniques in evaluating capital investment projects such as payback period, accounting rate of return, internal rate of return, net present value, and profitability index. Explain the process of ranking investment projects and explain the effect of inflation in capital investment analysis. So we start by defining what is a capital budgeting. This is used to describe actions relating to the planning and financing capital outlay for such purposes as the purchase of new machinery, modernization of plant facilities, or the introduction of new product line. It is actually an investment concept since it involves a commitment of funds today in order to receive some desired return in the future in the form of an additional cash inflow or a reduced cash outflow or savings. So with that definition, we can see that it is almost similar to what we have learned in chapters 11 and 12, that we have to make a decision uh, by uh, choosing between accepting or rejecting a particular proposal. Now, the only difference between the decision making under uh, non-routine non-routinary activities and capital budgeting is that capital budgeting entails a higher amount of funding and the commitment to allocate resources over a several time period. So in that case, management is expected to assess their funding capacity and should prepare an annual budget for this capital investment. Okay, next is the characteristics of a capital investment decision. Since capital investment are long-term commitments of resources to realize future benefits, it is important for managers to make uh, a crucial evaluation of each project and a thorough analysis for them to arrive to a proper decision. Hence, it is important for management to be able to uh, describe the characteristics of a capital investment decision. Number one, it requires substantial amount of funds, and because of the length of time spanned by capital investment decision, the element of uncertainty becomes more critical. Also, the effect of managerial errors will be difficult to reverse. Plans must be made well into an uncertain future, and success or failure of the company may depend upon a single or relatively few investment decisions. Now, we have two categories of capital investment. The first one is the independent capital investment project or uh, the screening decision. So in this category, the projects are evaluated individually and reviewed against a predetermined corporate standard of acceptability, resulting in an accept or a reject decision. Examples of these independent capital investment projects are investment in long-term assets such as property, plant, and equipment. So whether the company will purchase long-term assets for future use, new product development, undertaking a large-scale advertising campaign, introductions of a computer, uh, corporate acquisitions such as purchase of shares in subsidiaries or affiliates. So in this type of capital investment, the company sets some certain standards of acceptability, whether it could generate an expected rate of return, and whether this project could actually generate some sort of benefits such as savings in the cost of production, like in materials or in labor or in other overheads. Or some projects are also evaluated whether it could provide additional good company image or relations to the organization. So in this category, proposal or investment proposal or projects are treated independently and individually and not being compared to other proposals. Unlike in mutually exclusive capital investment projects, or normally they are called preference decision, the projects which are being proposed here are required to be evaluated and compared to other uh, project proposal. In this category, the proposed projects are also evaluated um, in comparison with other project proposal. For example, replacement against renovation of equipment or facilities, rent or lease against ownership of facilities, manual bookkeeping against computerized system, preventive maintenance against periodic overhaul of machinery, purchase of machinery from an outside supplier against assembly of a machinery by the company's own staff. So as you can see in this kind of or in this category of capital investment, it requires the company to choose one alternative or one project over the other and force them to uh, drop one option over the other. That is the reason why it is called a preference decision. Next, we go to the elements of capital budgeting. So we have three elements of capital budgeting that is being considered in evaluating capital investment. The first one is the net amount of investment. This is the initial cash outlay that is required to obtain future return of the net cash outflow to support a capital investment project. The second element is the net cash return. These are the net cash inflow expected from the project reduced by the cash cost, and that can be directly attributed to the project. And the minimum acceptable rate of return, which is the average rate of return that the company will earn from an alternative investment opportunities, or the cost of capital, which is the average rate of return that the firm must pay to attract an investment fund. So we will be applying and computing these three elements in different illustrations of as printed on your book also. So you could follow the illustration. So we first compute for the net amount of investment, or simply net investment. So the formula for computing net investment is initial cash outlay uh, increased by additional cash outlay related to the asset, additional working capital, and then deduct by cash inflow arising from sales of an old asset being replaced, and if there are any avoidable costs, and you will arrive at the net investment. Okay, so in short, whenever we purchase something that is considered or characterized as a capital investment, we don't simply get or pick the initial cash outlay. We need to add or consider additional cash outlay related to the assets, such as uh, the cost of transportation, the cost of preparation for the installation of that equipment, if that is an equipment, and other additional cash outlay related to that particular investment. Also, we need to add any requirement for additional working capital, such as additional requirement for inventories, or maybe supplies, or maybe in the form of cash. So if there are any additional working capital that needs to be fulfilled or committed in order to purchase that particular capital investment, we need to add that to our initial cash outlay, and then reduce it by uh, a cash inflow arising from the sales of an old asset. But this one is not always, uh, oops, hold on. Okay, so again, the reduction of cash inflow arising from the sale of an old asset is not always the case. It depends on the situation. If an old asset is being sold, or it does not entails any kind of uh, situation. And then we also need to reduce the initial cash outlay by any avoidable cost. And this avoidable cost should be net of tax effect. For example, if uh, the capital investment will require uh, disposal of an old machine, and therefore it will require uh, the recognition of its annual depreciation, and hence it will affect to an increase in net income, and therefore an increase in the tax liability. Okay, so that is net investment. Let us try to apply this one on this illustration. This illustration is also available on your reference. The management of Maingat Company plans to replace a sorting machine that was acquired several years ago at a cost of 60,000 pesos. The machine has been depreciated with residual value of 10,000. So the net book value is 10,000. A new sorter can be purchased for 96,000. The dealer will grant a trade-in allowance of 16,000 on the old machine. If a new machine is not purchased, Maingat Company will spend 10,000 to repair the machine. And then gains and losses on trade-in allowance in the transactions are not subject to income tax. The cost of repair on the old machine can be deducted in computing the income taxes, and income taxes are estimated at 40% of the income subject to tax. And there's an additional requirement of working capital in the amount of 50,000. Okay, so first we have to recognize that The book value of the old machine is already 10,000, which is equivalent to its residual value. However, it was given a trade-in value of 16,000, so it seems like we have a gain on the trade-in allowance of 6,000. However, also, it is mentioned that the gain or losses on trade-in transaction are not subject to tax. Okay, so the cost of the new machine is 96,000 and it will require additional working capital of 50,000. Okay, if the new machine is not purchased, Maingat company will spend 10,000 for the repair of the old machine. So let's compute for the net investment. The initial cash outlay is 96,000. The additional working capital is 50,000. So we have a total of 146,000. The trade-in allowance is 16,000. So we get the entire amount for the trade-in allowance and not the gain only. It should include the entire amount, 16,000. The avoidable cost net of the tax savings is actually the repair cost of 10,000. Uh, if we will not purchase the old machine, we will be paying a repair cost of 10,000. And in effect, the 10,000 will be deducted to our revenue, and therefore, uh, it will decrease our uh, tax base, which is the income tax. However, if we will purchase the new machine, we will not uh, incur any repair cost, and therefore it will increase our net income, and therefore it will increase our uh, tax liability as well. So we need to deduct the tax effect on the repair cost, and that is 10,000 multiplied by the tax rate of 40%, and that is equivalent to 4,000. You need to deduct the 4,000 from the avoidable cost or the repair cost of 10,000, and that is 6,000 pesos. Okay, so we add the two, trade-in allowance and the avoidable cost net of tax savings, equivalent to 22,000. So the net investment is actually 124,000, and not only the cost of the new machine, which is 96,000. Okay, so that is how we compute for the net investment in capital budgeting. Next, let us learn how to compute net cash return or the benefit that we are expecting from our project. We have two ways to compute for the net cash investment. Actually, four ways of computing, but uh, the other two is just an expansion of the other twos. Okay, let me show to you or explain to you the formula. First is we have to get the annual incremental revenue from the project and then reduce it by the incremental cash operating cost equals the annual cash inflow before tax. So the annual incremental revenue from the project may be in the form of cash inflow uh, presented in the problem annually. And then the incremental cash operating cost is the added or additional cash operating expenses that we will be incurring during the entire operation or entire use of the investment. Of course, you have to pick up it annually or do it annually. So we will get the incremental annual cash inflow before tax. And then we reduce it by incremental depreciation annually, and then net income before tax. I mean, you will get net income before tax. And then we reduce it by the amount of tax using the tax rate uh, given in the problem, and then you will arrive at net income after tax. And then you add back the incremental depreciation that you deducted previously from the annual cash inflow before tax to arrive at the annual cash inflow after tax. So the concept here is that um, we only squeeze out the cash inflow from our operation. And since depreciation is not a cash outflow, after deducting it from our cash inflow before tax, we need to add it back again to the net income after tax for us to arrive at the annual cash inflow or purely cash inflow after tax. So the improvement on this formula uh, is what is presented on the second formula. That is the annual cash inflow before tax, the same as what we have computed in the previous formula, is reduced by a taxes that is computed uh, with a deduction of the incremental depreciation to arrive at the final annual net cash inflow after tax. The annual net cash inflow after tax in this formula is also equal to what the annual cash inflow after tax uh, on the first formula, to what will be given or to what we will arrive at the first formula. Okay. The other formula for computing the net cash return is the computations of annual cash savings. Because again, what we have mentioned in the previous slide on the benefit or the expected benefit of a of a capital investment is in the form of cash inflow or a reduction of cash outflow, or in short, savings. So in computing for the savings, annual cash savings, uh, the first formula, the second formula has been improved by using the first formula. Okay, so ito po yung unang mahabang formula. Ang improvement niya is itong first formula. So what we do here is we get the cash operating cost if the old asset or method is used, and then we deduct by the annual cash operating cost if the new asset or method is used. So as you can see, we are comparing the old method and the new method to squeeze out the cash savings in applying the new method. After that, we less the incremental depreciation again, and then we will arrive at the increase in income before taxes, less the tax. We will arrive at the increase in income after tax, and then we add back again the incremental depreciation to arrive at the annual cash savings after tax. So the improvement here also uh, in the first formula lies on the taxes. So for taxes, for the computation of taxes, we will deduct the incremental depreciation. Okay, to better understand the formula, we will use this in our illustration, and this illustration is also available on your reference. The Lalay company is considering the acquisition of a machine which will cost 120,000. It has an expected useful life of 5 years, at the end of which at the end of which its scrap value is 20,000. The company expect to be able to generate annual cash before tax of 40,000. Estimated income tax rate is 30%. So we are asked for the annual cash flow after tax on this investment. So for this one, it's not a savings but an annual cash inflow. And we also have to recognize the depreciation of uh, the new machine, and therefore that is the incremental depreciation. And also the tax rate is 30% of the income. Okay, using the first formula, the annual cash inflow before tax is actually 40,000. So we were not given the annual revenue and the annual cost. We were given the annual cash inflow before taxes. Okay, kung hindi po given, you have to deduct the operating cash cost from the revenue na cash lang din. So cash revenue minus cost, ang cash operating cost equals cash inflow before tax. So it is already given to us and that is 40,000. For the depreciation, you can simply compute this one by deducting the scrap value of 20,000 to its original cost of 120,000. You will arrive at 100,000. Divided by its useful life of 5 years, you will arrive at 20,000. So as you can see, the cash inflow reduced by incremental depreciation will arrive at the accounting net income of 20,000, which is the base for computing for the tax. And that tax is 30%, and so that is 6,000. We will arrive at the net income after tax of 14,000. And then you add back again the non-cash expenses that we previously deducted from our cash income, which is 20,000. You will arrive now at the net annual cash inflow after tax of 34,000. Okay, so the concept here is to arrive at the purely cash inflow annually. So using the improved formula here, we pick again the cash inflow before tax and before the depreciation, and then we deduct it by the taxes. So following the formula, that is 30% of 40,000 minus 20,000. You will arrive at 6,000. So deduct 40 to 6 and we will arrive at the same annual cash inflow after tax of 34,000. Now let us try the computations of cash savings as a form of benefits in a capital investment. This illustration is also available on your resources. The Visayan division of Marlow Supply Company has been considering a new production method that can reduce materials by an estimated amount of 52,000 a year. So this one is an application of a production method, and the benefit is actually in the form of a savings in material cost, which is 52,000 a year. The new method is also expected to result in an annual savings of labor and overhead in the amount of 44,000. While depreciation using straight line method is estimated at 40,000 a year over a period of 10 years, Income taxes is estimated at 30% of the income before income taxes. What are the annual net returns or savings expected from the new product of the new production method? So the formula is to compare the old method over the new method. However, the old method is not given. We were given the uh, annual savings from the materials and the labor and overhead, and that is 96,000. Let us do it first on the using the uh, unimproved formula or the long method of computing the net cost savings. So 96,000 reduced by the incremental depreciation, which I believe you already know how to compute. Let me go back to the previous slide. Uh, no, it was already given 40,000. Okay, 40,000 annual depreciation. So you will arrive at 56,000 less the tax of 30% of 56,000, that's 16,800. So we will arrive at the increase in income after tax of 39,200. We add back the incremental depreciation. We will arrive at the annual cost savings of 79,200. Using the improved formula from the 96,000, we will simply deduct the taxes. And the tax includes the deduction of the depreciation. That's 30% of 96 less the depreciation. You will arrive at 16,800 and you will arrive at the same annual cost savings of 79,200. The third element of capital investment is the minimum rate of return. The minimum rate of return is different from each classification of capital. However, if you are given the entire compositions of your capital, you need to compute for the weighted average cost of capital. Unless the problem tells us or provided that the cost of capital pertains to a particular kind of or a particular component of your capitals. So uh, for the debt component of your capital or your liabilities, the cost of debt is equivalent to interest rate multiplied by the net of corporate tax rate. And that is 1 minus corporate tax rate. For preference shares, that's dividend per share over market value per share of preference shares. For ordinary shares, if it is a stock price based, expected cash dividend per share over current price per share of the ordinary share plus the dividend growth. Now, you will only use the stock price based whenever the dividend growth rate is given. If dividend growth rate is not given, then you will use book value based in computing for the cost of ordinary shares. And that is next year's project earnings per share, projected earnings per share over current price per share or ordinary shares. For the cost of retained earnings, the same of cost of ordinary, the same as what you have computed in the ordinary shares. And then for the weighted average cost of capital, you simply add up all the cost of capital uh, after multiplying it to its respective weight. And that is the proportion of each component to the total capital. Okay, so normally po sa mga problem na binibigay involving minimum rate of return, the weighted average cost of capital is already given. You don't have to compute for the weighted average cost of capital. However, for illustration purposes, we need to learn how to compute for WACC or weighted average cost of capital, uh, so that if it is not yet given, we know how to compute for it. Okay, for the illustration, this is also available on your reference. We have here the composition of a company's source of capital, bank loan, preference shares, ordinary shares, and retained earnings. The amount of their liability or bank loan is 300,000, preference shares is 100, ordinary shares is 200, retained earnings is 400,000 for a total of 1 million. So, in order to get the weight or the proportion of each component, you simply divide the amount of each component over the total. So for bank loan, that is 30%, preference shares is 10, ordinary shares is 20, retained earnings is 40%. Okay, in order for us to compute for the individual cost of each capital, we need this additional information. For the current market price per share of the preference is 62.5, for ordinary shares is 40. The dividend share for preference share is 5, for ordinary is 2. Dividend growth rate is 4%, corporate tax rate is 32%. So as you can see, whenever you see dividend growth rate, it is expected that you will be using the stock price base in computing for the ordinary share cost of capital. Oops. Okay, let's compute for each individual cost of capital. For the bank loan, we simply multiply the interest rate by the net effect of the tax, which is 1 minus 32%. We will arrive at 4.08. For the preference shares, we simply divide the dividend per share over the market value of the preference shares. Okay, market value of the preference shares, and that is 5 over 62.5, that is 8%. Okay, for ordinary shares, we will be using the stock price base because we were given the growth rate of 4%. So dividend per share of 2 pesos over the market price of the stock of the ordinary shares plus the growth rate of 4%, you will arrive at 9%. For the retained earnings, you simply copy pasted the cost of capital for ordinary shares, 9%. Now we can compute for the weighted cost of capital by multiplying each cost of capital by its weight. So 4.08 times 30%, 8% times 10%, 9% times 20%, and 9% times 40%. Add it up, you will arrive at a weighted cost of capital of 7.4%. Okay, the last slide for this part of the discussion is the categories of the project cash flow. We need to learn how to identify, we need to learn to identify which activities are cash inflow and which activities are cash outflow. So for the cash inflow, periodic cash inflow from operation should be net of taxes. Investment tax credit is a form of cash inflow also. Proceeds from sale of an old asset, net of tax, is a cash inflow. Avoidable cost net of tax. These are actually cost savings net of tax. Return of some working capital invested in the project net of tax consequence if there is any. And then cash inflow from salvage of the new long term asset at the end of its useful life is also a cash inflow. However, that is the end at the end of the useful life of the new assets. Cash outflow are the following: acquisition cost for the purchasing and installing of the new asset. Additional working capital is an outflow, and other cash flows such as severance payment, relocation cost, restoration cost, and other similar costs. Okay, so that's it for the first part of chapter 13's discussion of capital investment decision. The next part is the discussion of using evaluation techniques and will be posted after this. Thank you.